Well, this week, both the U.S. House and Senate will vote on the conference committee tax bill that will overhaul the tax code. Joining us now for today's Rural Money segment is Professor of Agricultural Law and Taxation at the Washburn University School of Law, Roger McEowen. Thanks so much for joining us, Roger. And what can we expect for income tax rates in regards to the conference committee bill?
Well, with respect to rates, they've kind of taken part of what the House did, part of what the Senate with replacing the existing rate structure with a new rate structure that will run from 2018 through 2025. So this is not permanent, and that's just the way that we have to deal with things coming out, particularly of the Senate. But we've got 7 rate brackets, and that's what the Senate had initially come up with, but the actual rates are different. The low end is 10%, the top end is 37%. So most people, I would say, are probably going to fall in a range of anywhere from 12 to 24%. That's where most people are probably going to end up.
Okay, well, how about the standard deduction?
Well, the standard deduction, and this is a really big change, starting next year through tax years that begin before 26, that standard deduction is increased for everybody, and it's going to be $24,000 on a married filing joint return, $18,000 if you're filing head of household, and $12,000 for everybody else, and that is a significant increase from what we've been used to.
How will commodity gifts be impacted?
Well, this is a really big issue for farm clients. A lot of farmers like to give grain to their children. They achieve a tax break for the family as a whole by doing that. But we've really got a nasty thing in the bill that stayed in the conference bill, and it looks like if this becomes law, obviously this is going to be in there. But once the child has $12,500 of unearned income, then the tax applicable to the child is going to be 37% on all excess amounts. So, again, that's a provision that's going to be there for tax years 2018 through 2025. So that's going to result in a large tax increase for a lot of families that do commodity gifts. So that practice we probably won't see anymore.
How about the impact on farm property?
Well, on the depreciation provisions, there's some really big changes here. It shortens the depreciable recovery period from 7 to 5 years for any machinery and equipment except grain bins and cotton ginning assets or fences or other land improvements that are used in a farming business that the original use of that property begins with the taxpayer and they place it in service after the end of this year. Also, they changed the required 150% declining balance method for farm property, and we get to go back to 200%, where it was a little bit over 30 years ago. Then you get immediate expensing of assets off the top. Expense method depreciation is going up. That's going to be a lot more. So the expensing of assets is really ramped up, and a lot of farm property is going to qualify for that.
Okay, now we know the president wants to get this passed before Christmas. Do you think that'll happen?
Yeah, I think it will happen. It looks. I would not be surprised actually if this is unanimous in the Senate in terms of all the Republicans voting for it. I don't think there'll be anybody that doesn't vote for it, and so they won't need Senator McCain to come back from Arizona. Although I could be wrong on that, but just reading the tea leaves right now, I think that's how it'll happen, and it won't be any problem in the House. And I do think now, I didn't think this was the case a few weeks ago, but I do think now they'll get it to the president's desk this week.
Okay, we'll see what happens. Thank you so much for your guidance. Roger McEowen with the Washburn University School of Law. Really appreciate you joining us.